Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Shad here, your hosts for this weekend's edition. This weekend show going to be very much focused on the resource sector and more of a half-year recap as we just turned the calendar over to July, a very broken up trading week this last week with Canada Day on Tuesday, July 4th on Friday. I think that gives us a good time to take a look back, see what happened in these markets, especially in the resource sector, because we saw a lot of commodities, metals especially, outperform the broad U.S. averages. Now, yes, it was a wild ride. U.S. markets went through a pretty severe, pretty quick correction. It was shortly around and after Liberation Day. But look, U.S. markets, those are also back to all-time highs, but it's the commodities and a lot of the commodity stocks that outperform the markets, maybe a bigger picture shift of capital, maybe just a half-year trend. Who knows? But it gives us a chance to recap what we saw in the first 6 months of this year. We are kicking off this show with Joe Mazumdar. Joe is the editor of Exploration Insights. Very valuable newsletter for all of you resource investors out there looking at individual companies to allocate your money towards. Joe, let's start off with kind of your overview. What we saw in the first half of the year in the resource sector. What stood out to you, Joe?
Well, I guess what stood out to me and the market in general is, the leverage provided by gold or precious metals equities. They were the best performing asset class in terms of the ones I cover on a weekly basis for subscribers. They were up about 58% in the first half, which is the proxy's GDXJ, and that's because the gold price was up about 27% and the silver price was about 23%. And so that's one component. But the best performing metal that I have is basically platinum. Platinum cumulative deficits that have been going on for a while and people are forecasting will continue. And then also in China, the jewelers are also, switching out from gold, which is much higher cost, to platinum with respect to jewelry, and that's adding even more tightness to the market, and hence the reason it's spiking. It's not just a catalytic converter demand. Some of that is said to be like a drop in EV demand, potentially in the States as well as in other regions, as having people building more internal combustion engines, which need the catalytic converters, which need platinum for diesel engines, and probably more so palladium for gasoline engines. But from what I understand, platinum is, when it was a lower price, was moving into the palladium market as well. And then you've got uranium doing well, uranium equities as well. They were up 30%. And overall, because the S&P TSX Venture is made up of a lot of these juniors and non-cash flowing resource companies that in the first half of the year had outperformed the benchmark equities in the US.
Well, Joe, one metal that we didn't discuss there that's had a nice light shown on it is copper. As we record this midweek, it's around 520. You've seen some life, not just in the copper price and maybe some forward outlook on the economy, but we've even seen the producers, as referenced by COPEX, Blast Hire, and even the copper juniors, the developers and explorers, have been getting a bid, which we hadn't seen in a while. What's your take on the red metal?
Yeah, absolutely. Copper was up about 13% in the first half, but the base metal equity ETF that I follow was basically flat. The XBM was like 1%. And, because base metals are made up of copper, but also zinc, and zinc was down 9% year to date. And so that's why equities were a bit flat overall. But, the ones that are more exposed to copper, they've done pretty well in the copper market. On the cathode side, we know is tight, and the actual forward curve is in backwardation, suggesting, the price at spot is higher than the forward price, trying to incentivize people with off-exchange inventories to bring those in to the exchange, but still people aren't bringing it in, because they want to have the actual copper cathode. And that's what people call the convenience yield. And that backwardation is evident on the cathode market. But then if we take a step back at the concentrate market, because most companies and mines produce concentrate, which goes to a smelter to produce cathode, the concentrate market, as we highlighted before in the call, is in negative territory. And so the treatment charges and the refining charges are what smelters charge companies for treating and refining their concentrate, which is a discount off of the copper price. But right now, because China has built up additional smelting capacity, and we've had projects like Cobre Panama go offline recently, Ivanhoe Mines had to change their guidance at one of the bigger mines in the world, which is Kamoa-Kakula, because of seismic activity that has impacted their water pumping abilities underground. That has all kept TCRCs negative, which is also, a positive for the copper market in terms of for producers. So yes, definitely copper has been well served in the current environment, and an add-on would be potential tariffs on copper cathodes coming into the U.S., which would give an advantage for people producing or potentially producing in the U.S. Ivanhoe Electric put out their pre-feasibility study for Santa Cruz, which is an underground copper project, leaching oxides and chalcocite, copper sulfide that's amenable to the solvent extraction, and leaching it there to produce a copper cathode. So all of this is good, and I've been bullish about the copper market for a while, and I continue to be so.
So, Joe, it seemed like the first half of this year, Q1, gold was doing really well, and gold even did well in Q2, but it seemed like there was a bit of a catch-up trade from some of the other metals in Q2 of this year. That's all taking out that noise from the very start of the quarter in April when we had Liberation Day and everything fell and everything rebounded quickly. Are the markets right now, considering gold has, for the most part, traded in a fairly tight trading range for the last about 2.5 months, are we seeing a catch-up trade in a lot of these other metals and commodities outside of even precious metals that are catching up to the really impressive moves gold has had over the last year now?
Yeah, for me, the gold market is impacted by different things than each individual market that we're talking about, and copper has its own underlying themes. We got into like potentially a rebound in nickel, which has its own themes. And there might be sort of a trickle-down impact by investors in the resource sector that are now looking. Gold has brought them in and opened the door, and now they're looking at other metals, especially the ones that are either critical or, let's say, security minerals that China is looking to ban the exports of, like we've seen for antimony and rare earths and things like that. So yeah, there could be that as well. But gold, what we're seeing is in the first quarter to April or May, around that time, the first 3 to 4 months of the year, we saw a lot of inflow in gold ETFs, especially from the North American funds buying gold equity ETFs. And so those not equity ETFs, gold ETFs, that tends to trickle down into gold equities, and that's why gold equities did quite well. That switched a little bit after Liberation Day. And now we're seeing a little bit more inflows, and probably the idea of this big beautiful bill coming in and potentially adding more trillions to the U.S. deficit over the next decade, and potentially a new Fed chairman that would do the U.S. administration's bidding and cut rates rather than keep them stable or raise them. It would be probably maintain people's bullishness for the precious metal.
Well, Joe, when we think about the gold equities and we think about the earnings potential as these prices keep moving higher, their costs aren't moving up to the same degree that the price has. So the prices outstrip the cost. And so you're seeing margins widen. Some of the widest margins we've ever seen. There's companies out there with $1,500, even upwards of $2,000 margins right now. And we saw Q4 of last year better than Q3, Q1 of this year better than Q4. we just finished Q2. We don't have the numbers out yet, but most people are expecting record revenues, because of these wide margins. Do you think that's all priced in at this point, or could that actually surprise maybe some of the generalists that don't follow the space as closely, and maybe they get shocked by the earnings potential of the sector?
Well, I mean, what I had seen for the first quarter versus the previous quarter was there was actually like what happens in the fourth quarter of any given year is people tend to ramp up their production. They ramp up their production because they're interested in meeting guidance. And the ability to meet guidance is important for them. And so they will squeeze production in most of their assets to make sure they make guidance. And so that Q4 is usually tends to be the biggest quarter of quarterly production. And then there's usually a drop off in Q1. So quarter on quarter, there's usually a drop off from Q1 to Q4. This year, the Q1 production was a bigger quarter on quarter decrease than normal. So there was like a 14% decrease in quarter on quarter production, according to Ron Stewart of Red Cloud Securities, which he took off of 10 senior and 19 intermediate North American listed precious metal producers. So that's suggesting there was a bit of an issue in Q1. But their costs, like you said, had gone up, but they're obviously not going up as high as gold, but their costs have gone up 3 to 4% for senior producers, but they've gone up more for intermediate producers, like 12 to 13%, so to around 60 to 80 per ounce. And so those sort of trends are what people are going to watch in Q2. Does production stay steady? Does it fall? What do costs do? A lot of the tariff talk hasn't totally been implemented, so I don't see people getting impacted by that yet. But I'd like to see what that does impact for people with not only their sustaining capital, but also potentially their, people that are building projects. How do tariffs impact those estimates that they're looking at going forward? But right now, as you point out, still the precious metals increase in price has probably more than offset the increase in costs so far.
So what about how the market's looking at it? We have finally started to see some of those inflows into equity ETFs. We even have Newmont, which we kind of have to use as a barometer for the at least gold sector. That's actually done pretty well and is at, I think, 52-week highs, at least very recently. Is the market in for a bit of a, I guess, shock when it comes to these earnings reports that could cause a further boost for the sector?
Well, I mean, last week, I think I was talking to somebody else, Agnico went down like 5% on one day. So we are seeing volatility, and part of that volatility last week was the on again, off again, geopolitical crisis between Israel and Iran, which might have pulled in the US. And so that was taken off, and so gold suffered a bit. I think the long-term thesis for gold is still positive. And I think, for any drop-off that we see in the gold price or in gold equities or ETFs is we need to see, I think we should be able to see people investing in the high quality plays. And that would be somebody like Agnico, that might be somebody like Alamos. They had issues in Q1, but they have the potential to rebound. So the quality companies, those ones, if there's any kind of pullback, those are the ones you want to get, because I think the fundamentals for gold remain bullish, especially if the US continues to increase its deficit, and they're pushing for a new Fed chair that may cut rates as opposed to raise or hold them.
Well, Joe, if we filter down from the producers and get down into some of the juniors, the developers and explorers, let's start with the developers first. A lot of them still are trading at ounces in the ground for, let's just say, $20 to $60 an ounce. And obviously, with these record margins the producers have, just two questions embedded in one here. Why aren't we seeing more M&A where they could actually buy ounces cheaper than they could explore for them? And do you think there's a catch-up trade coming in these developers where they should get maybe a better valuation on their economic studies based on where metals prices have been trending this year?
Yes. So what we've seen, and so in terms of proxy for a healthy market, it's not only returns on the equity, but we want to see the financings kick up, and we want to see more M&A. And so what we've seen on the financings, I mean, that is up, according to the S&P Global Market Intelligence, for the first 5 months of this year versus the first 5 months of last year. They're up about 20%, like 19% year on year. The number of transactions were flat, which means that the value of each transaction was up about the same percent, maybe 17 or 18%. Most of the transactions were from Canada on the TSX and TSX Venture, number one source of financing, also had the largest growth. But most of the money went into gold. So gold companies, or people that call themselves gold companies, saw the biggest funding increase. So of the $4.7 billion raised through all the exchanges and that, $2.6 billion of that was just gold. Base metals were actually down. So most of what we're seeing in terms of drilling projects and things like that, the news flow is coming from gold companies, less so base metal companies. So, there is a catch up to be had there, I think, especially probably for the copper projects and that. In terms of M&A, the M&A last year was probably held back a bit for developers because most people want production. They're willing to pay up for production because you don't take the capital escalation risk, you don't take any permitting risk or development risk. So you're just straight into production. And a lot of that production was coming off of Newmont's divestments. Now that's behind us, I'm thinking that we should see more M&A going to single asset producers and potentially single asset developers. So what was interesting to me as well is, we saw some intermediate producers where they can show more growth, and some of them that have done quite well, like Dundee Precious Metals, that's been an outperformer. They actually went for a base metal deposit, a polymetallic base metal deposit in their neck of the woods, which is Eastern Europe. They bought, they're proposing to take out Adriatic Metals, ASX listed. Another company, Harmony Gold, which has got obviously South African based, but they have exposure to Australia. They bought a copper producer, which is called Mac Copper in Eastern Australia. And so it's interesting to me that these companies are still keen on production. They're having a hard time potentially of finding, predominantly gold producing projects, but they're filling their pipeline with base metals, which they're, using as on an equivalent basis. Their gold production's going up, but they're truly base metal projects. So that's probably the competition here as well for single asset developing gold projects. Is there might be some more production out there from single asset base metal producers that some of these intermediates lean to, that are willing to take on some copper, some whatever zinc or whatever lead with some silver credit, those kind of projects. So there's a bit of a mix going on because Mexico is problematic still for precious metals and a big silver producer. We've seen a lot of M&A there with Gato Silver, Silvercrest being acquired, and now more recently Mag Silver being acquired. But most of that M&A has been from companies already operating in the country. We haven't seen a lot of people come from outside in. So for people looking for precious metals and silver exposure, they might be looking outside of Mexico. And so that's where I'm looking as well, to other places. Peru is another good producer of silver, but the problem with it is it's having problems with informal miners, which I saw earlier this year when I was there. And so more of my silver exposure now is in Chile and in Argentina right now, trying to look for projects outside of that risk profile.
Joe, I'm curious if you've done any research on this. The fact that, look, the last bull market, everyone got mad at the majors because they were just acquiring all these ounces in the ground at what was at the time elevated gold prices. And then 5 years later, when they might have thought about building those projects, the gold price was in a different position and they didn't want to build those gold projects. Now they've even offloaded some of them. Are the majors, at least in the gold space, which you are right, have looked to other metals outside of gold, do they have a pipeline, or how big of a pipeline do they have of projects in that development pipeline? So is that why they might not be looking at these ounces in the ground? Because while the gold price is strong now, we don't know where it's going to be in 5 or 10 years when these projects could come into the development timeline.
Yeah, I mean, I think people are like, if we're talking about, there's a difference between majors. I mean, some of these majors that produce, let's say, 3 to 4 million ounces per year, their ability to show a material impact on production lessens as they try to grow. You know, they get to an apex of their growth rate, and it's harder to find an asset that actually makes any difference. So most of them are basically running to stand still and have switched to the idea of trying to attract generalist investors that want dividends. So they've sort of, emphasized that part of their model that, hey, I offer dividends, so buy me because I'm liquid, I've got portfolio diversification, I've got gold exposure, but unlike the gold equity ETF, I give you a dividend. So that's basically their thesis. Though the intermediates can show growth. And so if they acquire or discover, they can make a material impact on their bottom line with respect to growth of production. And so when I'm looking at growth in M&A right now, I'm looking more at the intermediates because they have the paper and some of them have the treasury to actually start, accruing these assets into their pipeline. I would say for other companies, again, it's harder. But we're seeing the attraction now. I mean, we saw a little of this capital blowouts for these big open pit projects in Ontario, but some, they might be coming back into vogue. An example would be of what Discovery Silver, they had a low grade marginal open pit, project in Mexico that they were getting nothing for. They basically got out of that and, bought one of, Newmont's divested development projects. And yeah, they've totally turned around their story to becoming a story about an open pit, gram sort of deposit, gold deposit in Northern Ontario in the Timmins area, which is more amenable to current management, which, like Tony Makuchis, who's from that area. So there are different things happening with respect to trying to feed this pipeline and who can do what. But the other problem or the other thematic we have an issue with all the consolidation we've seen over the last decade, there's less suitors out there. There's not a lot of people in terms of demand because there's less companies, and the mega companies are having a hard time acquiring projects that actually make a material impact. They have to acquire other companies to do that.
Well, Joe, I think that's an interesting point that there's less seniors, but there are still a couple dozen of the mid-tier to small producers that could still bolt on some of these development projects. I guess my question is, when you think back to the last cycle in 2010 and 2011, yes, a lot of companies were overpaying for ounces, but they were paying $300 to $400 an ounce in the ground back then, or more in some cases. Some went up to $500 to $600 an ounce in the ground by 2011, and that was with gold at 1923 and margins for companies around 650. We're now looking at 1,500 to 2,000 margins. Again, I mean, maybe those will compress, but the gold price is far higher now, and yet these developers are still, again, only getting sub 100. A lot of them are $30, $40, $50, $60 an ounce in the ground. What does that mean for development stage companies? Why should companies go out and drill for more gold ounces if the ones that have already found it and delineated these deposits aren't getting fair value for them?
Yeah, I think some of the concern is permitting timelines. Like if I buy that ounce, I won't see that ounce for 10 to 15 years. I mean, some parts of the states and that they're trying to accelerate that, and which would make development plays probably a little bit more attractive, especially though because most companies are lazy. When they buy a development project, they want the permitting behind them. They want the feasibility study or a definitive feasibility study done with a consulting group that they use such that they trust the numbers. In a project that they infrastructure think that they can work in and jurisdictionally works for them as well. So they get very picky about what works for them and what doesn't work for them. And then because we've got less suitors, we've got less people that that, oh, hey, that could play a tuba versus a clarinet versus whatever instruments out there. Some places, I don't know how to play a guitar, so I'm not going to buy a guitar. So there's less of those people up. There's not two or three people out there or four or five companies out there that know how to play a guitar and will bid on that said guitar. We don't have that kind of liquidity on the M&A side just because of the consolidation. And then you have that other layer of being very picky and asking about, that I don't want to buy a project with a permitting issue because, I'm not bringing anything to the table. It still might take 10 years to build it. I want a material impact within the next 5 years of my CEO tenure, let's say. I'm not buying something for the next CEO of the company. That's not part of my, KPI. So yeah, these people want to bring a material impact, and that usually comes from production. So we've seen a lot of these producing assets get acquired, but some of them are still overvalued. So if you look at some of these single asset producers, some of them have a high price tag, and people aren't willing to acquire them. So then to your point, do they move to the next stage of development? I think yes, but they're going to move to the next stage of development where the company's got infrastructure, the company's got the permitting handled, they've got water access, power and all this other stuff, and they're well on their way to development, and potentially the company can see a clear path to getting this project within production within the next 2 to 3 years. That's, I think, the next level of M&A, whether it be in copper, gold, silver, or any of these other metals that see these kind of market dynamics.
Hey, for some of these mid tiers too, just let them build up some cash. Give them a little bit more time so that they do have that war chest to make some of these bigger acquisitions. Maybe that'll help as well. Joe, let's go down to the juniors then. The drillers, the explorers. They have raised a lot of money just in the last month or so. Man, oh man, the floodgates have really opened. I've been on record saying this is one of the best environments I've seen outside a couple short-term spurts where juniors are raising money and now they are going out and drilling. What are you seeing? I guess we can call it more down at the bottom of the food chain in the resource sector, whether it's gold, copper, really a lot of the different metals. The juniors have cash now and they're out drilling.
Yes. So if we take that same time period to the end of May, the total number of projects that were drilled for the first 5 months of the year, basically flat, same number of projects, but the number of gold projects was actually up 19%. What was down were people looking at specialty minerals like lithium, and that as that market has compressed, and that's one of the worst performing commodities was lithium carbonate equivalent, that's gone away. And what's taken its place to offset that loss has been gold. And the number of drill holes drilled within that period, slightly up 6%, over 20,152 holes drilled over the first 5 months that the S&P Global Market Intelligence recorded. But both gold and base metals, and I would say probably mostly copper, are up 10 to 13% in terms of the number of drill holes. And that was dragged down a bit by, again, these specialty mineral projects. It was down by 23%. So that money that we were talking about, that the more money going to the juniors and non-cash flowing companies, that money has been translated to more drilling, mostly for gold and base metals. And so most of the companies I look forward to in the portfolio have raised the money, and most of the money they've raised is 12 to 24 months worth of money, and significant drill programs. And most retail investors and people like that are interested in growth, so they're interested in more of the resource plays here, and they're definitely getting the people that generate decent results definitely get rewarded, in the current market. There's not anybody waiting for a liquidity play to dump right now on good news. They're definitely getting rewarded.
Joe, this is probably a question you've heard many times, and we've asked it many times, but I keep thinking about it as I was listening to you talking. Probably over 1,000 companies that are drill plays, that are earlier stage explorers. And all that capital that's raised that we just saw raised is going to need more capital again next year, we know, and maybe even in 6 months. And that's the hamster wheel where they drill, they hope they get market love, and they raise more money. Now, maybe we can get into that good cycle where they keep raising at a higher level, but are there just too many exploration companies fighting for the market's attention to really see, the cream rise to the top? There's a few that have been rewarded, but so many that are stagnant still.
Yes, and hopefully stagnant for a good reason, because they lack, let's say, the technical expertise. Jurisdictionally, they might be in the wrong spot, or their costs are very high for where they are. And so that's something else I look for as bang for buck in terms of drilling costs. So the markets, as we know, are finicky. Financing could be great one quarter and then bad the next. So you want to be able to invest in companies for bang for buck. They can do more with the money they have, and they're looking for the right commodities. Those are very important things to think about, and would probably be able to excise a lot of the wheat from the chaff in this market. So I put a lot of emphasis on the people, obviously, not only from a technical side, which is very important, but also from a capital access side, and knowing how to change their, allocate their capital depending on where the market is, because they have to raise money. And so if you're raising money for a commodity or in a jurisdiction that the market doesn't want to fund, you're going to have to change unless you're funded by some kind of money, which is another positive that I look for, is long-term money in a junior that could ride out the issues with the retail market. And so you need some of these long-term investors that will support the company no matter what. And it's usually the people that have the technical ability, access to capital, got the right projects in the right jurisdiction, right commodity exposure, that attract these types of funds. And so it's sort of, one feeds off of the other. And that makes it easier for me to recommend or to buy into these companies. And there is 1,000 or whatever plus companies out there, but just looking at the people, I could sift a lot of those pretty easy.
Well, yeah, as much as we want the journalists to come in, you are right. We do have kind of the diehard investors in those funds that have started, I think, to see a little bit of inflows, at least not the outflows that they were seeing, to support longer term these projects. But hey, Joe, any areas, jurisdictions that you see just as simply more interesting right now, or just has better action in it for investors?
Yes. So, I think Argentina, if you got the right province in Argentina, the current government is really pushing, and I think we've talked about this before. And, Salta was always a great province. I used to work there in Northwest Argentina. So that's a place that I'm very positive on. I think Chile is turning around. They're going to have an election coming up. Their left-wing government is even making permitting easier now, because they know they're going to lose the election, but they're making permitting easier. And so I think Chile's going to rebound, and I've got exposure to that part. I have limited exposure to Peru. My concern in Peru is not on the permitting side, but mostly for higher grade deposits that might be, and this could be a higher grade copper, silver, and gold, that these illegal miners are starting to make inroads. Not starting, they've been doing it for 10 years. That's become a big issue in Peru. I saw that when I was there earlier this year. I saw it when I was there late last year, and it's just getting worse. There's going to be an election in Peru. I think this is solvable, but you really need, a little bit of political force to do it. My exposure to Mexico is limited, and everything the current government, which is an extension of AMLO from a year ago, is suggesting that exploration in Mexico is not a thing. And, that even though they're not saying, to ban open pits, they're being very coy with how they advance anybody that wants to build an open pit. So I'm not overly exposed to Mexico. I like the US if you got the right state, because I think the federal government is much more positive on permitting. But if you're in a state which has very strong permitting laws like water issues or something like that, the federal government can't change that. So you got to be nuanced there. So yeah, I think there's a lot of nuances right now in terms of permitting with new governments coming in that, could impact juniors and especially developers as well.
Well, Joe, just one more observation. With the rise in platinum over the last really few weeks, we've had a lot of questions coming in about how to play platinum and PGM type deposits. And it really kind of brings in a broader discussion on, we've talked a little bit off mic about nickel, and a lot of the nickel deposits have PGMs as a co-credit, and also copper doing so well, tying into nickel and PGM. So when you tie all those metals together, copper, platinum, palladium, and nickel, are there opportunities in nickel companies that could be ways to play platinum and copper? Are there copper companies where you can play nickel and palladium and platinum? What's your thoughts on tying those polymetallic deposits together?
Yeah, so polymetallic deposits have, and people try to do this with their, either nickel equivalent, copper equivalent, then they throw everything in. Metallurgy is very important for polymetallic. So when you get one of these deposits, you got to really understand, the metallurgy and whether you can actually generate any revenue from these byproducts. Because some of these guys will say, okay, we're going to produce this concentrate and that concentrate, but then you look and they don't even recover the byproducts. They might not get the PGEs, they might not get the gold, so that's an important thing, a caveat to look at once you're considering this. But so I am looking, because I do think that there's a potential for the nickel market to rebound, because Indonesia has oversupplied the market. We've seen BHP and some other companies take low grade, high cost production like in Western Australia offline. So that's no longer impacting the market. So, that takes a little bit of a while to get through the market. And now we've seen BHP go in and make an investment in a nickel project in Tanzania. So I think if you can find a base metal project that's polymetallic, that's, can lower their cost through the byproduct or co-product credits, you're in the right, area for development in terms of jurisdiction. I think there's windows there of taking advantage of that. And then that's definitely what I'm doing with my last round of site visits. I have been looking at those sort of projects.
All right, Joe, we'll wrap it up here. Interesting to recap this first half of the year. And hey, a lot of opportunities in the resource sector with a lot of these underlying equities also doing very well and outperforming the broad averages. Let's hope that just carries through to the second half of this year in a prolonged bull market, because right now it's been good times for resource and commodity investors for the last year plus, and it's been different spurts of commodities doing well. But at the tail end of the first half of this year, we really saw all these other resources and commodities play catch up with the underlying stocks, and that money filter down into the juniors. Again, Joe Mazumdar, editor of Exploration Insights. Click the link in the show notes to sign up for Joe's newsletter and follow along with the companies, the sites he's visiting, and the companies he's writing up. Joe, thank you so much for your time on this weekend show.
Great. Thanks a lot, guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report, and continuing with our half-year recap focused on the resource sector, mostly precious metals now, as we are chatting with Dave Erfle. Dave is the founder and editor of the junior miner Junky, joins us pretty much on a weekly basis to share his outlook on what's happening in the gold, silver space, as well as the equities. And hey, this first half of 2025, a great start of the year for precious metals, even silver playing catch up, but gold up about 25% this year. The gold stocks have done even better, I believe, than gold, especially at the tail end of this first half of the year. But Dave, this brings up kind of a big picture question that we were talking about off mic, and quite frankly, debating back and forth. That is, what is driving gold here? We hear about recession fears. We hear about this whole anti-America trade or rotation out of America trade, as well as all the other geopolitics going on. So, Dave, in your eyes, gold continues to perform very well, but what's driving the price?
Yeah, well, since mid-April, the technically long-term extreme overbought gold price, it's basically been consolidating within a 10-week bull flag around 3,300. And I think a big driver is the US. They continue to do everything they can to drive down the value of the US dollar. And that's keeping the gold price well bid here going into the second half of 2025. Look, we had central banks continuing to buy gold on the de-dollarization trade, and we had gold price go up 27% last year, and now it's up another 25% just in the first half of this year. And it's basically growing unease over Trump's on again, off again, on again, off again tariffs, and this tax cut and spending bill, which was just passed right before we started talking. And that's going to add up to 4 trillion to the national debt, which just passed 37 trillion last week, and that's on everyone's mind. And so it's led to a scurry of investor outflows from dollar denominated assets in the past few months, that on top of the 4 trillion over the next decade that this is going to add, these numbers could be very conservative if there's a boycott of buying US Treasury bonds, because that could lead to higher interest rates, which we saw earlier this year. So, and we got the Fed, who's stuck between a rock and a hard place. They're terrified to raise rates because that'll sink the bond market, and they're terrified to lower rates because that'll sink the US dollar. So they do nothing. And then they've got Trump on their case, calling Chairman Powell stupid, and now saying that he's going to replace Federal Reserve cabinet members before he can actually replace Powell in May of next year. Okay, we're going to put these guys on the board that maybe we're going to replace Powell with in the future. So all this is losing confidence in the government. It's losing confidence in the system. Investors are realizing that, hey, governments now have no impetus to pay any of this back. These deficits are going to continue to grow until there's a sovereign debt crisis, and gold just continues to move higher.
Well, and Dave, when we think about the stew of factors, yeah, there's been geopolitical tensions really since Ukraine started in 2022, and it hasn't really let up. But those have been a constant in the background, and there was some flare-ups, obviously, over the last month or so. But gold price hit record highs of 3,500 and some change, 3,509 on the futures market in April, before a lot of the Iran-Israel tensions really got heated up. But there was already that undercurrent. There's been the sell America trade and the diversification out of dollars and also out of euros, because the second biggest holding in central banks now is gold, even more so than the euro. And there's all the financial gyrations, not just in the US, but globally. There's the China factor, that's what's going on in Europe. There's all these different tensions, what's happening in Japan. But if we pick all of that and we just put all of it to the side and just look at it from a technical standpoint, in the second quarter, gold had its highest quarterly close of all time, and the gold producers probably had their highest revenues of all time. So just from a technical standpoint, could it just be that gold has been in a solid momentum technically?
Absolutely. And it's rising. It's making all-time highs in all currencies. So that is hugely bullish. And like you said, we've had another quarterly all-time high close. And silver also just had a 13-year high quarterly close. It closed above that $35 level on a quarterly basis. The momentum players are going to start, looking at this and say, and silver is a tiny market. And once you get momentum traders and big money coming into a tiny market, it can move it really quick. Now we're looking at the 37.50 level on the silver price. But something also to consider is, we talked about last week, I think it was last week, we talked about the US going in and dropping those bunker buster bombs and saying that they've destroyed Iran's uranium enrichment facilities to make nuclear weapons, and they went in, went out, said it was over, and basically none of the Iranian oil fields were hit. The Strait of Hormuz wasn't closed, so the idea of that happening in case the U.S. was going to bomb, because I mean they controlled the skies over Iran, and it was just inevitable. And the market bid up the gold price, bid up the oil price on that happening. And then once it did happen, and those oil fields weren't hit, the oil price cratered back down to $65 support. But the gold price continued to hold support around that $3,300 level. So that, like I said, that tells me that when you have all this budget situation going on and this bill being passed that's going to add so much to the debt. I mean, look, Trump ran on this platform of finally doing something about the debt, right? I mean, they formed Doge and they said they were going to cut all this spending, and nothing became of it at all. And now all of a sudden it's not a problem, and we're just going to continue to borrow and spend and do nothing about the deficit. And these interest payments alone on the debt will continue to skyrocket, and governments cannot do anything about it, about paying down the debt, and the Fed can't do anything about it. So the Fed's trapped because they can't do anything about government spending. They can only react to it. And then, you've got, like I said earlier, you've got Trump saying that, hey, we're going to get rid of Powell, and we're going to do, and maybe do it even sooner, but he can't do that because it's an independent body. So all this, Gold's looking at all this and just consolidating those gains to 3,500 that happened 10 weeks ago, and with a bullish bias. And if you take a look at the gold stocks, gold finally came down and closed below its 50-day moving average for the first time in like 115 trading days. That hasn't happened in like 10, 15 years. Gold was getting really, really overbought. It came down and closed below its 50-day moving average last week. Well, the gold stocks didn't. They held their 50-day moving average. And gold stocks are now leading. They're showing relative strength to the gold price consistently for the first time in quite a long time. So that tells you that the gold price, the market expects the gold price to remain in this bullish consolidation, waiting for a catalyst to take it higher.
Look, when it comes to what's driving gold, I don't think we can also ignore the fact that central banks have been buying gold for the last 15 years, and just in the last few years, the last 3 or 4 years, they have hugely increased their buying of gold. That helps. US dollar crashing this year, that also helps. It's just a good picture for gold. But then in terms of the stocks here, quite frankly, gold is kind of channeled sideways for the last 2.5 months. We have seen, at least in the last month and a half, rotation into the smaller stocks, and some of the majors have kind of slowed down some of their trends. Some of the outperformers I've noticed have also more or less consolidated some of their gains, moved sideways, which is what we do see sometimes when the gold price goes sideways. We do see money move down the food chain. Do you foresee that still happening then? This rotation of money, people locking in gains in terms of some of those outperforming stocks and moving down the food chain into the juniors?
Yes, it's happening now, and I expect it to continue. I mean, I've got several of the juniors that I'm invested in. They continue to bifurcate higher while the sector is correcting. So you're seeing outperformance of the juniors now. Quality juniors are outperforming the minors because they're so much more undervalued. I mean, miners are still undervalued in relation to the price of gold, but the juniors are so much more undervalued in relation to not only the price of gold, but to the miners. So I expect this to continue, absolutely. And if you take a look at the GDX, it's the most extreme overbought on a monthly basis, long-term monthly basis, than it's ever been. And weakness continues to be bought, because if you take a look at where the gold price is, and you take a look at what these stocks are trading at, they're still trading like the gold price is below 3,000, while it appears to me that gold is attempting to create a floor at 3,000. And we talked about this last week about if you take a look at Newmont, I mean, they're going to be announcing their second quarter results on July 24th. And they're the big dog of the sector, right? They've been lagging the sector for so long. The stock had to digest that Newcrest takeover, and they had to get rid of some of their higher cost mines. They sold several of their higher cost mines. So now they're lean and mean. I think they're down to like 10 top tier gold mines with plenty of reserves and lower costs. And they paid off a lot of their debt. They're buying back shares. They're paying a dollar dividend per year now. And if you take a look at their chart, they've got this 3-year inverse head and shoulders bottom that it's breaking above the neckline here while the sector is correcting. So Newmont's been leading. I think they produced 1.2 billion of free cash flow in Q1. The gold price is like what, $275, $300 higher in Q2, and their costs came down last quarter. And so even if their costs remain the same or come up a little bit, I wouldn't be surprised to see them free cash flowing 1.5 billion in Q2. I mean, and that's a yearly run rate of $6 billion if the gold price stays at, above this $3,300 level. So that is huge. And like we've talked about before, it's the only gold stock on the S&P 500, and it's the big dog. And that's the stock. You could see it now that retail is starting to get into, because they've ignored this sector for so long. And even though the stock market, AI's gotten back up there, the crypto's gotten back up there, and you would expect to see some rotation coming out of gold stocks and maybe people getting back into AI and crypto again, but that's not happening. You're seeing the gold stocks maintain their gains and even add to them. So that is huge. I mean, we were waiting for so long for the stock market to roll over to get some sector rotation into gold stocks, and we saw that, but we had a V bottom in the stock market, and yet gold stocks continue to climb with the stock market now.
Well, Dave, with that kind of environment where the stock market's at all-time highs this week, the S&P and the Nasdaq, and then when you have the fact that crypto's become reanimated again, does that steal some of the luster from the earnings of this Q2 gold stocks that are coming up? Or better yet, has the market properly priced in Q2? Because we keep hearing it's all priced in, but I don't think most generalists are even paying attention. Could some of the earnings, not just in Newmont, which is the pace car, but some of the mid-tier, some of the other big seniors, could some of these earnings shock generalists?
Well, I'm shocked to the upside, I would imagine, yes, because if you see ETF inflows, Western ETF inflows are starting to rise now, finally. So that is showing you that Western interest is coming into gold more, coming into gold stocks more, even though, like I said, even though the stock market has, eclipsed its all-time highs again. I'm still of the ilk that I believe the stock market's creating this huge top. I mean, the CAPE ratio is about 37 now, and it's getting close to the dot-com bubble high. So the stock market continues to be historically overvalued, and gold stocks are still very undervalued in relation to the gold price. So there's still plenty of upside, even if the gold price continues to trade sideways above 3,000. Matter of fact, I would welcome it. I would like to see the 2950, 3,000 level tested, but I don't know if it's going to happen because there's so many tailwinds for the gold price here.
Yeah, I'd like to see these companies do something with, I guess, their cash, whatever they're earning here, because quite frankly, look, we can all forecast what their production's going to be and what the price is. Let's get them actually doing some stuff with this capital. What about the silver price? Because silver is clearly moving, I think, mostly because, well, gold's been moving. It's playing catch up to gold. Yes, we can talk about all the supply demand aspects, but quite frankly, this just seems like a catch up to gold trade. And I know so many of the investors that are in this sector, have been in this sector for a long time, that is going into or that are focusing on the smaller silver stocks that quite frankly just haven't moved. some have started to move. They're up 50, 60% just in the last month or so. But Dave, what do you think the potential is for these small silver stocks that really have been unloved?
Oh yeah, I mean, we talked about this before, the single asset mines coming off that are being picked off by the majors, single asset silver mines because they're so rare, and the juniors that are de-risking these large primary silver assets, they're really starting to take off. And like I said, they've bifurcated higher from the sector as the sector corrects. I mean, SIL just made a multi-year 52-week high. SILJ is starting to catch up, but I mean, look at the volume on SILJ last month was the highest volume in its history. So there is attention starting to come into these silver stocks, and the quality ones have really started to move. And if you take a look at the higher risk silver juniors along with the higher risk gold juniors, some of the optionality plays that are earlier stage, they've started to move, but they haven't come anywhere near where these later stage juniors have already gotten to.
Well, Dave, when you think about some of these smaller junior silver stocks starting to move, a lot of people get concerned and say, oh, that may mark the end of the cycle. But really, silver is one of the few commodities that's never made an all-time high yet compared to most of the other commodities. I think there's one other agricultural commodity that hasn't. But other than that, all of the other metals, oil and gas, they've all broken out to new highs. Silver hasn't yet. So isn't there still a lot of room to run in the silver stocks when silver makes its journey to 50 and hopefully beyond?
Oh, absolutely. I mean, the deficit continues, right? We're in the fifth year of a silver deficit. There's more and more applications for silver. AI, there's all these AI applications that need silver, the solar situation. I mean, and most of the silver that's produced, as you know, comes as a byproduct from mining something else. So you can't all of a sudden have all this silver come online because there's a silver deficit. So I mean, and that's starting to get more notice. So yeah, I mean, if the gold price runs, once it breaks out and it runs to 4,000, which is its next target, silver running to 50 would still keep the gold silver ratio relatively high at 80-1. That's another thing to keep. That's very notable here is the gold silver ratio closed below 89 here this week, closed below 90 this week. It closed at 89. So that's trending in the right direction. So while gold's consolidating sideways, silver continues to move higher with a bullish bias as it attempts to break out of its bull flag before the gold price. So the silver price still has plenty of catching up to do with the gold price.
How about a whole other commodity, copper? Copper's above $5. Some of the copper stocks have started doing well too. Just continues to be, again, a good environment for a lot of different investments, but we're focused on resources. A lot of good resource companies moving. Are you moving into any copper plays as well as the precious metals?
Yes, I have a few, and they're performing. They're outperforming. They're doing really well, and there's a couple on my watch list. There's one I'd like to get into. There's a couple of my stocks are very close to tripling, and once they do, I will sell 1/3 to take my original investment out of the stock, and then I'll have more cash to put to good use into some copper stocks. And there's a couple that I like. And one is a PEA stage copper gold junior that I really likes, but they need cash here really soon. So it's going to be interesting to see when they announce a finance. Number one, how the finance is going to come about. Will a strategic be interested because their PEA was fantastic? So I wouldn't be surprised if they've attracted a strategic partner and maybe they're working out something with a strategic partner to get more capital. Because if you see a company that is able to do a bought deal or do a strategic finance with a mid-tier or a major miner without a warrant, that is hugely bullish for the stock. It legitimizes the project to the market, and the stock will immediately start to re-rate. We saw that happen with one of my silver juniors that is really outperforming here, and that's Abra Silver. as soon as Kinross came in and did a strategic placement with them, the stock really took off.
Well, Dave, in an environment like this where gold is holding steady, the gold stocks are outperforming gold, silver is catching up to gold and outperforming it, the silver stocks are waking up, and even the junior silver stocks, and they still have probably some room to run. Copper just put in its highest monthly close, and it was back-to-back highs on the, as far as the quarterlies, and then platinum has woken up, and even other metals are starting to wake up. We talked about this before the call, but are we entering a recession here, or are we entering a reflation trade? What does it mean that all of these metals are rising kind of in tandem here at the same time that people are worried that the economy is falling apart?
Yeah, it's really interesting. I mean, with all these worries about a recession taking place, I mean, we have negative GDP growth now, and we have higher inflation. We have stagflationary fears going on. We've even got the Fed coming out and basically saying that we're in stagflation. I mean, Williams, one of the Fed head, Williams, he came out and basically said we got low growth, we got slowing labor growth, and we got sticky inflation, and that's basically stagflation. But if we're going into recession, why is the copper price now rising above $5 a pound? And I think the reason is because of the tariff fears, right? So on the one hand, you've got recession fears, but on the other hand, you've got the tariff fears of people are securing as much material as they can before they're hit with tariffs. So it's really interesting how this is playing out. And also you've got the dollar going down at the same time. So that makes these metals more attractive. And it's just a very good environment for not only the precious metals, but for copper as well.
Yeah, we'll wrap it up here, Dave. It is a good environment for resources, commodities in general. And yes, we are hearing still a lot of those recession fears, but we're just not really seeing it in the data quite yet. And the markets aren't telling us this. So maybe it will come in the second half of the year. Maybe things will just keep trucking along. But as of right now, nice to see the capital also be focused more on commodities and even more so on the underlying equities. So Dave, thanks for taking time with us on this weekend show. And everyone, thanks for joining us on the long weekend down in the U.S. and celebrating half of the year. We are halfway through 2025, and boy, oh boy, what a headline-driven year it has been, and looks to continue on next week with all the headlines, especially around tariffs that will be coming. So everyone, thanks for tuning into this weekend show. Please be sure to go back to our website, kereport.com, and search for our podcast in your podcast player. Just search The KE Report. You can also follow us on YouTube and through Substack. So everyone, again, thanks for taking time with us on this weekend show. Hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.